There was a number so big, so systemically dangerous, that even the world's most powerful governments refuse to acknowledge it publicly. That number is 90 trillion, but it's not printed money, it's not GDP, it's not even real debt. At least not yet. It's something more dangerous, shadow debt. A hidden web of off-balance sheet leverage, derivative exposure, and unregulated financing that has quietly grown to be larger than the entire global stock market combined. But what's worse is not just what this debt is, it's who controls it. Banks don't, governments don't, the Federal Reserve doesn't, and that's why, when this bubble bursts, the markets won't correct. They'll snap, and most people won't see it coming until it's too late. Most people believe they've got a grip on how much debt exists in the world. They've seen the headlines, $300 trillion in government, corporate, and household borrowing. It's a terrifying number, even on its own. But what if I told you that this number, huge as it is, isn't even close to the real total? Because beneath the officially recorded debt that governments and banks are willing to admit lies another kind of debt. A debt so large, so deeply embedded in the world's financial plumbing, that it doesn't even show up on traditional ledgers. A debt so hidden that most economists don't even have a name for it. Except one, shadow debt. And once you understand what shadow debt is and why it exists, you begin to see something horrifying. The world economy is just leveraged. It's rigged like a house built on invisible explosives. Shadow debt doesn't exist on the record books. You won't find it in Federal Reserve reports or IMF breakdowns. That's because shadow debt isn't created the way normal debt is. It doesn't come from borrowing money from a bank or issuing government bonds or running up a credit card. Shadow debt is made through financial engineering, the quiet, behind-the-scenes games played by hedge funds, institutionals, banks, and offshore entities. The kind of debt created not by lending, but by betting. Here's the easiest way to understand it. If traditional debt is a loan someone expects to be repaid, shadow debt is a promise someone expects not to default. It's not backed by houses, factories, governments, or collateral. It's backed by confidence. And confidence, as history has proven, is the most fragile asset in the world. What kinds of things qualify as shadow debt? It shows up in repo markets, where trillions in overnight loans happen every day, backed by collateral that can vanish in a single moment of panic. It shows up in credit default swaps, where companies don't borrow money, but instead insure loans against failure, creating billions in obligations tied to debt that barely exists. It shows up in offshore dollar loans, debts owed in US dollars by companies who don't operate in America, don't bank in America, and don't report their dollar exposure to American regulators. And most dangerously of all, it shows up in derivatives, multi-trillion-dollar financial contracts that sit completely off balance sheet and behave like real money until the moment they don't. You've probably heard the term derivatives before. What you likely haven't heard is how big they've become. Today, the notional value of derivatives, debt built entirely out of bets, leverage, and contracts, exceeds 600 trillion, and while not all of it is active exposure, even a fraction going bad can trigger the kind of chain reaction that no central bank on earth is prepared to stop. That's where shadow debt lives, in the cracks of the system, in the loopholes, in the quiet corners that regulators pretend don't exist, because admitting their existence would mean admitting something far worse, that the real financial system has escaped the control of the people who are supposed to be in charge of it. Most people think 2008 was caused by subprime mortgages, but the truth is much darker. The real reason the world almost collapsed was because one company, AIG, couldn't pay off its shadow debt. It had written billions in credit insurance on mortgage-backed securities. But when those securities started going bad, AIG didn't have the cash. The entire derivatives system, worth trillions, was about to collapse. So what happened? The government bailed them out. Not to save AIG, but to save everyone else depending on them. This is the part of the story they don't teach in school. Governments can bail out banks. They can support the stock market. They can backstop mortgage bonds. But they cannot bail out shadow debt without risking the collapse of fiat currency itself. Because shadow debt is just huge. It's uncontained. It exists in places no one is monitoring. It's passed between entities no one regulates. It operates on platforms no central bank has visibility into. It functions like a parallel financial universe, larger than the one most experts think they understand. Most people think the global financial system is a structure. It isn't. It's a web. A web held together by trust, liquidity, and collateral. The problem with shadow debt is that it erodes all three, quietly, systemically, invisibly. And now, after decades of growth, something irreversible has happened. Shadow debt has outgrown the real financial system that spawned it. Which means one thing. When this parallel system breaks, when the confidence that holds it together finally cracks, it won't just take down risky hedge funds or over-leveraged banks. It will take down everything that depends on money flowing freely through global markets, every pension fund. Every insurer, every portfolio and investment vehicle and retirement plan and commodity chain on planet Earth, because you can wind $90 trillion of invisible leverage without breaking the machine that feeds it. And yet, most people have no idea it even exists. So how did it get this big? How did it get this deep? And why is 2026 the moment it finally breaks? That's where we go next. It didn't begin with a scandal. It didn't begin with a crash. It began with a quiet realization inside boardrooms and ivory towers during the late 1970s. A realization so powerful that it changed the financial world forever. If banks couldn't expand under existing rules, then they would build a system with no rules at all. In the decades after World War II, banking was almost boring. Regulators enforced strict leverage limits. Banks had to hold real deposits before making loans. Lending was conservative. Growth was slow, and nobody could create money out of nothing. But by the 1970s, a problem emerged. The world wanted more credit than the banking system could legally supply. Corporations wanted to expand. Governments wanted to spend. Consumers wanted to borrow. And Wall Street saw hunger and smelled an opportunity. Except there was a problem. Banks were capped. They couldn't issue more loans without raising more deposits. But raising deposits takes time. It takes trust. And trust takes generations. So bankers asked a dangerous question. What if loans could be made without deposits? What if credit didn't need to be backed by savings? What if the entire concept of money in, money out could be bypassed legally? That question gave birth to something new, the shadow banking system. Unlike traditional banking, shadow banking didn't need buildings, tellers, or customers. It didn't need savings accounts or regulatory compliance. It operated in a financial gray zone, using new inventions like repurchase agreements, Eurodollar lending, and derivatives to act like banks, but without being banks. So instead of lending $1 for every $1 they held, shadow banks could lend $10 or $50 or $100, backed not by cash, but by paper promises. And because these promises looked like money, behaved like money, and were traded like money, the world accepted them as money. That's the key. Shadow banking doesn't create dollars. It creates dollar obligations. Obligations that act like dollars until the moment someone actually asks to get paid. This wasn't fraud. It was innovation. At least that's what they said. Hedge funds joined in. Money market funds joined in. Pension systems joined in. Big corporations joined in. Offshore financial hubs became the arteries of the new dollar system. London, Hong Kong, Singapore, the Cayman Islands. We didn't just build a financial system. We built a shadow version of one. Bigger, faster, and unregulated. By the 1990s, the shadow system was already larger than the traditional banking system. And yet, almost no one outside Wall Street understood what it actually was. Not politicians, not the media, not even the Federal Reserve, until it was too late. And then came 2008. Most people think the financial crisis was about bad mortgages, but subprime loans weren't big enough to destroy the world. What destroyed the world was the shadow machinery built on top of those loans. Mortgage lenders issued loans. Banks pooled them. Shadow banks turned them into securities. Hedge funds borrowed against them. Derivatives insured them. Repo lenders financed them. It was a tower of leverage built on a foundation of sand. When the first layer collapsed, the whole structure fell. But here's the part the public was never told, and it wasn't just the banks that needed a bailout. It was the shadow system attached to the banks. If the Fed hadn't stepped in, the global dollar system would have collapsed in days. Not just Wall Street, not just the mortgage market, the entire plumbing of international finance. 2008 should have been the end of shadow banking, a wake-up call, a reckoning. Instead, the world made a decision. If the system was too fragile to unwind, then it was too big to fail. So we didn't dismantle it. We scaled it. The same people who created the first shadow markets were now given permission to build bigger ones. Shadow debt doubled, then tripled. Synthetic risk exploded. Derivatives went from trillions to hundreds of trillions. And governments, instead of stopping them, became dependent on them. Shadow banking had become the real financial system, and the real financial system became a front. Which brings us to today. You can find shadow debt on a balance sheet. You can vote it away. You can bail it out without risking the destruction of the US dollar. Shadow banking is now the operating system of global finance, and in the next crisis, it won't be central banks deciding who survives. It will be the players inside the shadow network, the ones who move money no one else even knows exists. And once the first domino falls, the world will learn a brutal truth. You can regulate the banks. You can regulate what replaced them. The question now is simple. If this system wasn't built by governments or voters, then who built it? And what happens when they lose control? That's the next layer of this story. Most people are taught a simple version of how money works. You deposit $1 in a bank, the bank keeps a portion and loans the rest. That's called fractional reserve banking. It's been around for centuries. But what most people don't know is that this system, the one we think controls how money is created, is what creates the real risk anymore. Because in shadow finance, a single dollar doesn't just get loaned once. It gets replicated, multiplied, stacked, turned into promises, bets, and synthetic assets until $1 behaves like 100. And it all happens in the shadows, invisible, unregulated, yet capable of shaking or collapsing the global financial system in a matter of days. Let's break it down. In the traditional banking system, you deposit $1,000. The bank might lend out $900 and keep $100 in reserve. If you and everyone else tried to withdraw your money at the same time, the system would collapse. That's called a bank run. And that's why the Federal Reserve exists, to backstop banks when confidence cracks. But the shadow system doesn't need deposits. It doesn't need customers. It doesn't even need money, because it doesn't deal in dollars. It deals in claims on dollars. Claims that can be issued, reissued, bundled, borrowed, reposted, and traded like real money, without ever being backed by cash. This is the leverage multiplier. Here's how it works. A hedge fund might use $10 million in collateral to borrow $90 million in cash for a trade. That's 10-to-1 leverage. But they don't stop there. They take that borrowed money and buy derivatives, contracts linked to interest rates, currencies, mortgages, or commodities. Those derivatives are then posted as collateral to borrow again, and again, and again. By the time the cycle is done, $10 million in real money has created $500 million in obligations. None of it exists. All of it is treated as real. This is how we ended up with a global derivatives market valued at $600 trillion. Not a typo, not a conspiracy. Public data from the bank for international settlements, and yet less than 2% of that has real cash behind it. Just think about that. Here's the scary part. As long as no one asks to cash out, the system works. As long as everyone believes the promises will be honored, the machine keeps spinning. That's why banks look solvent until they don't. Take a look at 2008. Lehman Brothers was brought down by mortgages alone. It was brought down because the value of its mortgage derivatives collapsed, and everyone who had lent the money suddenly wanted collateral. That's the hidden danger with leverage. It works both ways. It multiplies gains until it multiplies losses. In a rising market, shadow leverage is unstoppable. It inflates asset prices. It creates liquidity out of thin air. It makes fund managers look brilliant. It makes the rich even richer. But in a falling market or a rising interest rate environment, leverage becomes a weapon. Because the moment collateral falls in value, the people who borrowed against it get margin called. And when they get margin called, they have two choices. Sell assets immediately or default. And when enough people sell at the same time, the system doesn't correct. It breaks. That's what happened in October 1987, when the Dow fell 22% in a single day. That's what happened in 2008. That's what happened in 2020, when repo markets froze and the Federal Reserve had to step in with trillions in liquidity overnight. And now it's happening again, except this time the system is more leveraged than ever and interest rates are rising instead of falling. That's the real problem. Shadow debt depends on low interest rates. If money is cheap, you can borrow more. You can refinance, you can roll over old debt with new debt. But when rates rise, when the cost of borrowing doubles or triples, the math stops working. And we are now in the most aggressive rate hike cycle since the 1980s. A cycle that has detonated regional banks, crushed mortgage markets, frozen bond issuance, and triggered sovereign debt crises from Argentina to Egypt. But that's just the beginning. Because while you can bail out banks, you can bail out $90 trillion of synthetic leverage, not without destroying the currency backing the bailout. That's the paradox we now face. The system cannot exist without leverage, but the leverage cannot survive rising rates. The fuse is already lit, and the first sparks are showing up where they always do, in the safest parts of the system. Treasury auctions, money markets, credit spreads. What comes next won't be gradual. It will be sudden. Which raises the question, if $1 can become $100 on the way up, what does it become on the way down? Because when the collapse starts, it won't be banks or governments who control it. It will be the shadow lenders, the collateral holders, the leverage architects, and the ones who thought they understood money, only to learn they were standing on a trap door. But the real trigger, the moment this leverage chain snaps, that begins in the place almost nobody's looking. And that's where we go next. It's easy to remember 2020 as the year the world shut down. Streets were empty, shopping malls went dark, unemployment spiked. News outlets framed the story around lockdowns, stimulus checks, and epidemiology charts. But while the world obsessed over masks and mandates, something far more dangerous was happening behind the curtain. Something that almost nobody noticed unless they were watching the plumbing of global finance. Because the real crisis of 2020 wasn't the pandemic. It was what the pandemic triggered. A total freeze in global liquidity. And in a financial system built on leverage, derivatives, and synthetic debt. When liquidity freezes, everything dies. In March 2020, something unprecedented happened. Global markets didn't just fall, they stopped. Repo markets, the overnight loans that function as the heartbeat of global finance, froze. Interbank lending stiffened. Hedge funds couldn't get collateral. Companies couldn't roll over commercial paper. Offshore borrowers couldn't find dollars to repay dollar-denominated loans. This wasn't a recession. It was a circulatory failure. Most people don't realize this, but almost everything in our financial system requires someone else to lend. If you own a corporate bond, someone needs to bid it. If you run a hedge fund, someone needs to repo your assets. If you're a global company refinancing debt, someone needs to lend dollars against collateral that may be falling in value. When those someones all disappear at once, the system suffocates. And for a terrifying 72 hours in March 2020, the shadow banking system was seconds from flatlining. You didn't see it on the news. Most politicians didn't even understand it. But inside the Fed, inside the primary dealer banks, inside offshore dollar desks, panic wasn't a headline. It was a lived reality. The only thing that stopped total collapse was an intervention so massive, so fast, and so extreme that it broke every rule of monetary history. The Federal Reserve created $4 trillion in weeks, not to send checks to families, not to support small businesses, but to bail out the dollar reserve system. Here's the part almost nobody knows. When Congress announced stimulus checks, that was the real stimulus, when the media focused on PPP loans and unemployment relief, they missed the real bailout. Because the first $2.3 trillion didn't go to people. It went to bond markets, repo facilities, swap lines, and liquidity backstops. In other words, the first entity rescued in 2020 was not the American worker. It was the shadow banking system. The Fed opened emergency lending windows not seen since 2008, and they did it in the dead of night. They issued swap lines to foreign central banks to provide access to US dollars. They backstopped money markets. They bought corporate bonds. They literally broke the last taboo in monetary policy. For the first time in history, the Fed bought junk bonds. Why? Because the shadow system, the real engine under the global dollar, was cracking. And if shadow credit failed, the entire world economy failed with it. This wasn't a political decision. It wasn't a stimulus. It was a rescue mission for a system too fragile to withstand panic, too leveraged to unwind, and too interconnected to let die. But here's the tragic irony. The Fed didn't fix the problem in 2020. It only papered over it. When you print money to solve a liquidity crisis, you don't solve the crisis, you delay it. You make the system dependent on future bailouts. You turn liquidity into an addiction. You teach markets that risk doesn't matter because the central bank will always step in. And that's exactly what happened. By 2021, the system was running on adrenaline. Corporate debt hit record highs. Shadow leverage exploded again. Derivatives grew. Private equity firms borrowed trillions. Sovereign debt ballooned. Asset prices went parabolic, not because of growth, but because of injected liquidity. It was the single largest wealth transfer to the top 1% in human history. But every bailout has a cost. That cost arrived in 2022 in the form of the highest inflation in 40 years. And here's the catch. You can print money forever, not without destroying the value of the currency you're printing. In 2020, the Fed had one tool, unlimited liquidity, and it worked once. But now, rates are rising. Inflation is still elevated. Public trust in currency is eroding. Foreign buyers are dumping U.S. debt. Geopolitics are fracturing the global dollar base, which means the next liquidity crisis, the next repo freeze, collateral shock, or derivatives unwind, can be solved the same way. Because if the Fed prints another $4 trillion, the U.S. dollar doesn't just wobble, it burns. And here's the final truth that almost no one is ready to face. The 2820 bailout didn't save the system. It saved the collapse for later. And that later, according to every debt cycle, every rollover schedule, and every liquidity model, is 2026. So the real question becomes, if the Fed can print its way out again, what breaks first? That's where we go next. Debt cycles don't just collapse out of nowhere. They aren't random. They aren't mysterious. They're scheduled. Like a timer built into the structure of the financial system itself, buried under spreadsheets, hidden behind policy speeches, ignored until the countdown reaches zero. History doesn't repeat, but credit cycles do. And every time they reset, the same pattern emerges. Rising debt, rising leverage, rising interest costs, liquidity crisis, collapse. Each one landed inside the same 15-20-year cycle, and each one marked the end of a financial regime. Now we're at the edge of the next one, and every indicator points to 2026 as the inflection point. The year the pressure becomes too much, the liquidity too little, the rollover too large, and the shield of central bank intervention finally cracks. The first reason is simple math: interest rates. For over a decade, the world borrowed money assuming rates would stay near zero forever. Corporations issued trillions in low-interest debt. Governments refinanced endlessly. Banks leveraged portfolios. Hedge funds borrowed against collateral that barely had a pulse. But the era of free money is over. In just 18 months, the Federal Reserve raised rates from near zero to over 5%, the fastest tightening cycle since 1981. And that single act didn't just make mortgages more expensive. It detonated the one assumption holding the entire debt machine together. Borrowing costs will always be cheap. When that assumption dies, everything built on top of it dies too. The next problem is rollover debt. Debt doesn't disappear. It needs to be refinanced, rolled over, renewed, reissued. And in 2025, 2026, the largest refinancing wave in human history hits all at once. $1.8 trillion in U.S. corporate debt must be rolled over $9 trillion in U.S. Treasury debt needs refinancing. $2 trillion in European sovereign debt matures. Chinese developers face over $500 billion in defaulted collateral emerging markets owe dollar loans they can no longer afford at double the interest rate. This is the financial equivalent of every borrower in the world showing up to the same bank window at the same time. After the bank has doubled the price of money, borrowers don't default because they can pay today. They default because they can refinance tomorrow. 2026 is when tomorrow arrives. Then there's the bond exodus. Foreign governments used to buy U.S. Treasury bonds as a safe reserve asset. That era is ending. China is selling. Japan is selling. Oil producers are reducing holdings. Even the Fed has stopped buying, which means America's biggest borrower, the U.S. government, is running out of lenders. So the Treasury is now forced to issue record-breaking amounts of debt into a shrinking buyer pool at rising interest rates. That's not a debt market. That's a fuse. At the same time, Europe is facing a silent sovereign crisis. Countries like Italy, France, Spain, and Greece are carrying debt loads that only made sense when rates were near zero. Now that rates are above 4%, these economies are running out of fiscal runway. Their debt wasn't paid down during the good years. It was leveraged. And then there's China, a nation whose economic engine is built on collateral tied to real estate. But Chinese housing markets are collapsing. Property developers are defaulting. Entire cities have become ghost infrastructure. The collateral base for China's credit market is evaporating at the exact moment the world needs China to be a growth engine again. Every region, every market, every borrower now has the same problem. Too much debt, too little cash, too high interest costs. And when everyone needs liquidity at once, liquidity disappears. Normally, the Federal Reserve would step in, lower rates, print money, inject liquidity, stop the bleeding. But this time they can't, because inflation is still in the room. If the Fed prints trillions again, it doesn't save the system, it destroys the dollar. That's why 2026 is different, because this time the Fed is out of cheat codes, which means something else has to break instead. And in a crisis, the first thing to break is always the part of the system built on leverage, not cash. Liquidity, not savings. Confidence, not collateral. That part is the shadow debt market, the place where $1 becomes $100 until someone asks for the $1 back. The structure that's invisible during growth, but catastrophic during contraction. The machine that can only function under low rates, now stuck in a rising rate world. This is the fulcrum. This is the breaking point. This is 2026. And when the shadow debt market finally starts to unwind, it won't be a slow leak. It will be a sudden snap. The only question now is, where does that snap start? That's where we go next. The most dangerous part of a financial crisis is not what collapses first, but what collapses quietly. Stocks get the attention. News cameras roll when the Dow drops 1,000 points. But stocks are where the real damage begins. The real collapse starts in the places most people never see. The places where the financial system is linked together through invisible contracts worth trillions. Those contracts are called derivatives, and when they fail, everything else follows. Derivatives are supposed to protect the system. That's what they were designed for, to manage risk. Banks, corporations, and funds use derivatives to insure against interest rate moves, currency swings, defaults, and credit losses. On paper, they reduce uncertainty. In reality, they concentrate it. Because every derivative has two sides, a buyer and a seller, a promise and a counterpromise, a contract that only works if both sides survive. Which brings us to the problem. If one major borrower defaults, a sovereign government, a real estate giant, a multinational corporation, the contracts linked to that borrower detonate. Everyone who sold protection suddenly has to pay up. The problem? In the shadow world, the people who sold the protection don't have the money to pay. That's exactly what happened in 2008. One company, AIG, had insured billions in mortgage-backed securities. When those securities fell, AIG owed more money than it had ever made in its entire existence. It didn't just fail. It set off a global chain reaction. Banks didn't trust other banks. Hedge funds couldn't get collateral. Repo markets froze. The entire system began to liquefy into panic. It took a government seizure and a multi-trillion-dollar rescue to stop the bleeding. Now take that same mechanism and multiply the leverage by 50. That's where we are now. The first dominoes will not fall in the US stock market. They will fall in credit derivatives linked to over-leveraged banks in Europe and failing debt in China. These are markets where debts were rolled over for years under zero interest rates. Now that rates are rising, those borrowers are stuck. They don't just owe money, they owe dollars. And that creates a dollar shortage. A dollar shortage does mean dollars disappear. It means too many borrowers owe dollars and too few actually exist in circulation to cover the obligations. Because global trade and global lending happen in dollars, not won, not euros. When the crisis hits, every borrower with dollar-denominated debt will rush to buy dollars, just like in 2008, just like in 2020. But this time, there's a fatal difference. In 2008, the Fed could print. In 2020, the Fed did print. Now, the Fed is trapped by inflation. And if the Fed can print, then the dollar shortage becomes a dollar panic. Imagine a world where multiple dominoes fall at once. A major Chinese property conglomerate defaults. European banks lose their collateral. Credit default swaps are triggered. Hedge funds need to post more margin. Lenders demand repayment in dollars. Dollar borrowers all over the world scramble to find currency they don't have. Derivatives unwind, collateral evaporates, liquidity dies. This isn't hypothetical. This is the math of the system as it stands today. And here's the chilling part. There aren't enough dollars in the world to meet all outstanding dollar claims. Take a look at the offshore dollar system, the euro dollar market. It has grown to over $13 trillion in obligations that exist outside the United States. That money isn't backed by the Fed. It's backed by private lenders, shadow banks, and synthetic contracts. In a crisis, all of those dollar liabilities convert into dollar demands. And there is no lender of last resort behind them. This is the moment the system is just stressed. It snaps. Because when derivatives fail, dollars disappear. And when dollars disappear, liquidity collapses. And when liquidity collapses, markets stop functioning entirely. What comes next is not a crash, it's a seizure. A global margin call on the backbone of the financial system. And this time, the Fed won't be able to save everyone. If the Fed prints trillions to stop a dollar shortage, inflation explodes. If it doesn't print, the dollar shortage becomes a global credit event. Either way, the system takes damage it cannot recover from. That's why 2026 is the turning point. Not because something new is happening, but because everything that already happened finally converges. Now the question becomes, if the credit dominoes fall first, what falls next? Because when liquidity disappears, it's not just trades and derivatives at risk, it's collateral. And once collateral breaks, so does the entire financial architecture. That's what we uncover next. There's a moment in every financial collapse when the illusion of stability shatters. Not gradually, but instantly. It's the moment when things don't just fall, they stop working. Not because everyone is selling, but because no one is willing to buy. That moment is when markets snap. And it always happens the same way. Not with a stock crash, not with a headline, but with the silent death of something the average person never sees, collateral. When shadow debt begins to implode, you won't hear it first in the S&P 500 or the Dow Jones. Stocks trade last. They react after the damage has already been done elsewhere. The first signs will show up in places most people never watch. Places like credit spreads, junk bond auctions, and currency swaps. The early signals look like this. Investment-grade bonds suddenly need much higher yields to attract buyers. High-yield debt, junk bonds, can find buyers at all. Currency swaps start breaking par value. The euro-dollar swap goes negative. Corporate refinancing rounds get canceled. Interbank borrowing shrinks, not because money isn't needed, but because trust disappears. That's when the oxygen starts thinning out. Credit spreads blowing out is not a graph problem. It's a blood pressure problem. It means lenders are backing away. It means risk is rising faster than rates can be reset. It means nobody wants exposure to what used to look like safe debt. And then, the breaking point. Collateral stops being accepted. You've heard the word collateral before. Most people think it means something you put up to get a loan. But in global markets, collateral is everything. It's the core ingredient that makes leverage possible. Treasuries act as collateral. AOA corporate bonds act as collateral. Certain mortgage-backed securities act as collateral. Even some forms of sovereign debt are used as collateral. But when a crisis starts, collateral doesn't just lose value. It becomes unacceptable. Suddenly, the thing you thought was worth $100 is worth $80. Then no one wants it at all. That's the moment the shadow banking system decouples from reality. Because once collateral breaks, nothing can be rehypothecated. No assets can be borrowed against. No loans can be rolled forward. No derivatives can be collateralized. No repo agreements can be trusted. It's not that lenders want higher rates. It's that they don't want to lend at any price. That's what happened in 2008 when mortgage-backed securities stopped being accepted at par. That's what happened in 2020 when even U.S. Treasuries, the safest asset in the world, experienced bid-side evaporation. And when collateral breaks, interbank lending stops. If banks can trust each other's collateral, they stop lending overnight credit. If they stop lending overnight credit, the repo markets collapse. If repo markets collapse, global liquidity dies. And when liquidity dies, markets downfall. They freeze. In that freeze, something terrifying appears, the air pocket. Traders use the term air pocket to describe what happens when prices downfall gradually, but instead gap down instantly by 5%, 10%, 20% in seconds. There's no bid, no support, just a vacuum. That vacuum opens when there are no buyers left, not because stocks are worthless, but because nobody can get cash, not because bonds default, but because nobody can roll contracts, not because currencies fail, but because nobody can swap dollars. That's what people don't understand about liquidity. Liquidity is in volume. Liquidity is belief, and once belief breaks, there's no circuit breaker, no bailout, no buyer of last resort, not even the Federal Reserve, because the Fed can print dollars, but it cannot print collateral, it cannot print trust. When collateral dies, leverage collapses. When leverage collapses, the system resets. This is the point of no return. Some investors will try to escape to cash. Some will think they've prepared because they're holding safe assets. But when the shadow banking system implodes, two brutal truths emerge. Cash is only safe if you can access it. Collateral is only valuable if someone still accepts it. The real crash is when stocks go down. It's when markets stop functioning, not trading down, not trading at all. That's why this moment matters, because once the freeze begins, it doesn't unwind gradually. It does return to normal. It accelerates into a full system reset, just like 2008, but on a scale too large to backstop. And if the Fed steps in again, if they try to inject emergency liquidity like they did in 2020, they didn't just risk inflation, they risk currency destruction. That's why this time is different. That's why the break isn't just a market event. It's a structural event. And when the structure breaks, it doesn't just change stock prices. It changes power, which brings us to the next phase of the crisis. Because once markets snap, the question becomes, who gets blamed, who gets protected, and who gets sacrificed? That's what happens next. When the system finally breaks, when liquidity vanishes, when credit locks up, when markets stop trading, politicians will walk out in front of microphones, stunned, wide-eyed, and performatively confused. They'll say things like, "No one could have seen this coming. The models didn't predict this. We were blindsided." And the media will repeat it, and most people will believe it. But here's the uncomfortable truth. The crisis wasn't unpredictable. It was undeniable, and they ignored it. In every major financial collapse, politicians need a villain. In 2008, it was subprime borrowers. The story was simple. Irresponsible homeowners took out loans they couldn't pay. That narrative was false, but it was enough to distract from the real architects of the crisis. The banks, the credit rating agencies, the derivative engineers. It turned a global Ponzi scheme into a morality lesson about personal responsibility. But this time, that narrative won work. There is no subprime villain, no bad borrower, no easy scapegoat, because the next crisis won't begin in households. It will begin in the halls of institutional finance. The most powerful players in the system, hedge funds, global investment banks, private equity lenders, digital asset platforms, and central banks, are the ones who engineered the leverage loops now primed to detonate. In other words, this time, the arsonists are the ones holding the fire hoses. So when the dominoes fall, watch the rhetoric shift. You'll hear words like unforeseen leverage issues, unexpected derivative exposure, structural fragility, liquidity event. All euphemisms for a truth they will never say out loud. They knew the system was unstable. They knew it was over-leveraged. They knew they were creating obligations no one could repay. And they did it anyway, not because they were stupid, but because the system rewarded it, because the bonuses were immediate, the risks were distant, and the crashes were always somebody else's problem, until now. The most dangerous moment of the next collapse won't be the financial freeze, it will be the political reaction. Because when the public realizes what's really happening, when they see hedge funds quietly bailed out while pension funds evaporate, when they see second homes in Aspen protected while mortgages in Detroit are foreclosed, when they see trillions flow into swap lines while grocery prices double, the anger won't be local. It will be global. You'll see protests in Europe, not about tax fairness, but about central bank corruption. You'll see political collapses in emerging markets, not over ideology, but over dollar dependence. You'll see governments turn on each other, not because of treaties or land, but because of liquidity. Austerity will return, but not for the people who built the system. Bailouts will return, but not for the people who paid for them. Because when the elites built shadow finance, they built a machine that protected their gains and exported the losses. And when the cost of the final reset comes due, Workers, savers, retirees, small business owners, the people with no leverage and no lobby, will pay that cost first. The truth is, the data was never hidden. The warnings were never secret. The structure was always public. It was just too profitable to fix and too complex for most people to understand. That's why this moment will mark a turning point, not just financially, but socially. Once people realize the crash was random, once they see who was protected, once they understand that the system was not broken, it was designed to break this way, the backlash won't just be against a policy. It will be against the entire architecture of power that allowed it. The Fed won't just lose credibility. It will lose legitimacy, and governments won't just lose trust. They will lose control. Because when money fails, politics follows. And what fills the vacuum? That's what comes next. Every financial collapse does just destroy wealth. It destroys the rules that used to define it. And when the rules collapse, something even more powerful replaces them. That's why every crisis in modern history has led to a reset, not just of markets, but of money itself. In 1933, that reset came through gold confiscation. The government forced citizens to turn in their gold in exchange for paper, giving the state full control over the monetary base. In 1971, the reset came when Nixon ended the gold standard entirely and replaced it with something new, the petrodollar, a system where oil could only be purchased in US dollars, giving America global monetary dominance. And in 2008, the reset was about currencies at all. It was about liquidity. Central banks created trillions in new dollars through quantitative easing, turning the Federal Reserve into the buyer of last resort for everything from mortgage bonds to corporate debt. But the next reset, the one that will follow the collapse of shadow debt, won't be about banking systems or bond markets. It will be about control of currency itself. Once the shadow credit machine collapses, the world will confront a brutal realization. It's not just banks that fail. It's the dollar system that fails with it. Because the shadow system isn't just a parasite feeding on dollars. It is the dollar system. A massive offshore ecosystem where synthetic dollars, derivative dollars, leveraged dollars, and collateralized dollars circulate without ever appearing on the Federal Reserve's balance sheet. When that evaporates, when trillions in artificial liquidity suddenly unwind, the world will experience a dollar shortage unlike anything in history. And when a currency system fails, it doesn't get repaired. It gets replaced. Which means the next phase of this crisis is already taking shape. Not in markets, but in the plans being drafted by central banks and supranational institutions. That replacement is programmable, centrally controlled digital currency. Call it CBDC, call it digital cash, call it modernized payments. The branding will change, the function won't. The purpose of a central bank. Digital currency is simple, to rebuild the financial system without the volatility, freedom, or anonymity of the old one. A digital dollar doesn't need banks. It doesn't need clearinghouses. It doesn't need shadow credit markets. It only needs one thing, central authority. Imagine a world where every dollar is traceable. Every transaction is approved in real time. Every loan, every salary, every purchase is connected to a digital identity, where money can be frozen, expired, taxed, redirected, or programmed based on behavior. That's not a conspiracy. That's already being piloted in Europe, China, the US, India, and dozens of emerging markets. They'll tell the public it's safer. They'll tell the public it's efficient. They'll tell the public it prevents fraud, terrorism, and tax evasion. But what they won't say is this. The new system doesn't give you ownership of money. It gives you access to money. Until the system says otherwise, that is the reset, not a new dollar, a new definition of what a dollar is. And most people will accept it, not because they trust it, but because the alternative won't exist. When pensions collapse, when markets freeze, when credit dies, when banks limit withdrawals, when the old money system implodes, people won't demand freedom. They'll demand stability. And the offer will be simple. Accept the new system and we'll restore your savings. Accept the digital dollar and we'll protect your deposits. Accept the reset and we'll reopen the economy. A trapped population will say yes, because when money fails, ideology dies. Which is why the people who prepare now, before the reset, will have one advantage left, economic sovereignty. Not through gold alone, not through crypto alone, not through cash alone, but through understanding how power shifts when money changes form. The reset won't destroy wealth. It will transfer it. From those waiting for the old system to return, to those already stepping into the new one. But the reset leads to something even bigger. Because once new money is issued, once currency becomes programmable, there's only one question left. Who controls the code? That's where it all ends. And that's where the final chapter begins. One day, people will look back at the year 2026 and say the same thing they always say after every collapse. No one could have seen it coming. They'll blame a sudden event, a geopolitical shock, a recession, a war, a virus, or a political scandal. They'll call it a black swan. They'll say it was random, a fluke, a once-in-a-lifetime anomaly. But that will be a lie. Because the truth is, the collapse didn't start in 2026. It started decades earlier. The moment we traded money for debt, debt for leverage, and leverage for synthetic financial engineering. That's when the countdown began. 2026 is the beginning of the crisis. It's simply the moment the system runs out of runway. For over 50 years, we've operated in a world where money wasn't real, it was credit. And credit was backed by anything. It was backed by the expectation of future growth. That worked for a time. It worked when populations were growing, productivity was rising, interest was low, and globalization created new buyers for every new dollar printed. But the world isn't expanding anymore. It's contracting, aging populations, slowing productivity, rising costs, shrinking liquidity, geopolitical fragmentation, currency distrust. These aren't economic headlines. They're the death signs of a system held together by confidence instead of collateral. And confidence is not renewable. Think of the global financial system like a tower of blocks. At the bottom is the foundation. Real money, real assets, real savings. Then on top, bank credit. Then above that, corporate debt. Then above that, government debt. Then above that, derivatives. Then above that, shadow leverage. And finally, at the very top, synthetic liquidity. Financial promises built on nothing but expectations. For 40 years, we've been adding blocks to the top of that tower without reinforcing the bottom. And in 2026, the tower doesn't just shake, it shifts. When interest rates rise, the bottom blocks weaken. When liquidity dries up, the middle blocks loosen. When collateral breaks, the top blocks crash. That's what makes 2026 different, not a single event, but a synchronized failure across interest, debt, currency, liquidity, collateral, and confidence, all at once. That's why people will be blindsided. Because no one taught them to look at the system, only the surface. They'll focus on stock charts. They'll watch GDP headlines. They'll repeat whatever the Fed chair says on camera. They'll believe the bailout will arrive in time, because it always has. But this time, the central banks are out of tools. They can cut rates without inflating asset bubbles. They can print trillions without collapsing the currency. They can stabilize markets without destabilizing society. And that's when the public will understand the final truth. The system was never designed to last. It was designed to expand until it broke, and so the divide begins. Some will freeze, waiting for things to go back to normal, not realizing that normal was the bubble. Some will blame governments, corporations, banks, or billionaires, not realizing they were living inside the same abstraction the elites built to protect themselves. Some will lose everything, not because they made bad decisions, but because they trusted a system built on promises instead of guarantees. But a minority, a very specific kind of person, will be prepared, not because they predicted the exact crash, but because they understood the design. They will have liquidity while everyone else has panic. They will hold assets outside the collapsing system. They will move capital before capital controls begin. They will protect sovereignty before digital currencies take it. They will think in systems, not in headlines. Those are the people who, one, look back on 2026 with shock. They'll look back on it with clarity, because they understood the real rule of financial history. Crashes don't destroy wealth. They transfer it. And what's coming next isn't a recession. It's a transfer event, the final unwind of the dollar-based shadow system, the repricing of everything that was held up by leverage, the battle for control over the next version of money itself. And once the breaking point arrives, once markets snap, liquidity dies, and the shadow system implodes, there will be no do-overs, no pause button, no wait and see, no recalibration. Only two outcomes. You're either holding claims that vanish or holding assets that survive. You're either trapped inside the reset or positioned outside of it. You either own liquidity and sovereignty, or you get absorbed into the new system. That's the final warning of 2026. Not the crash is coming, but the system is ending. Because once the shadow debt breaks, the world doesn't just lose money. It loses the illusion that money was ever real. And the people who understand that, before the breaking point, are the ones who will write the next chapter of history. Everyone else will just live in it.